Markets do not move in straight lines. This is a trend, but there are a lot of moves within this trend, swings. Notice this trend has also broken down for the S&P 500. Hey everybody, this is Brant from Wolf on Wall Street Trade and thetechnicaltake.net. Picking up from last weekend's video, we still had a bear flag in the S&P 500 at that point. And it looked like this. So on Monday, for our subscribers, price target for a measured move, if this breaks down, if we do not get support over here, 55.35 to the 55.50 area. So let's take a look at the S&P, see what it did as we roll forward into the end of the week, right down to that 55.35. So as we saw last week, bearish price action continued. We weren't getting any 3C signals of any kind of importance that suggested that we were at a pivotal turning point, just an area to watch. For the Dow Jones Industrial Index, this is where we were at last weekend's video, and we had a measured move down to 40,875. The Dow tagged that measured move, and you can see it kind of moved above it a little bit here on Friday. I can't really get any measured moves from the NASDAQ because the sell-off has been so persistent in tech stocks, but we do see a number of small bear flags that really don't even have a chance to form. I think that's probably the closest they start, and it's like a 1 day or 2 day kind of correction, and we go down and down again. And in last weekend's video, I talked about the SOX index, or the semiconductor index, at about the 9-minute and 45-second mark of the video, and that it had a head and shoulders top. And here's a daily chart of the SOX index with left shoulder, head, an elongated right shoulder, and we finally broke down all the way to the neckline. So we have a fully formed head and shoulders top in the semiconductor index. While this is very bearish for the long term, this is an area of local support, and I've been talking about that to subscribers this week, that this area is likely to act as a speed bump in this decline. As far as the longer term picture, the measured move for the SOX index is down to about 3,100 once this head and shoulders neckline breaks. But often we get kind of like a whimper rally or some kind of little bounce right over here. Doesn't form another shoulder, but say it came up to like 4,800 or 5,000 even, and there's chances it couldn't even be that strong. But still, it tends to act as a speed bump, so we did reach that level this week. In last weekend's video, I also talked about NVIDIA at the 11-minute and 15-second mark, and some positive changes in character that we were seeing around the 110 level in 3C last week. So let's take a look at NVIDIA. Last weekend's video would have been as of right here, and this is the 110 level. So you can see NVIDIA hung out around and bounced off that level this week. It also broke out above my trend channel, which has held the entire downtrend. So only moves on the close will violate this downtrend and trigger a stop. And that is exactly what NVIDIA did over here on the 12th. Changes in character lead to changes in trend. Keep in mind that this is happening as the SOX index is coming down to that head and shoulders neckline. Because I don't have enough price history on this 1-minute chart of 3C and NVIDIA, I can't show you all of what happened, but 3C was coming down into this 110 area. I can show you what a screen capture looked like on NVIDIA's 3C chart as of last Monday, the 10th. And this was posted for subscribers. NVIDIA's chart is looking interesting. So this is as of the 10th. You can see 3C coming down with price and then positively diverging in this area around 110, 112, somewhere in there. And we've seen a pretty decent move in NVIDIA this week since then. As stocks come down, this is kind of important into the broader market, how it fits into the broader market. So we're definitely seeing a change in character in the most important semiconductor stock, and probably one of the most important stocks, if not the most important stock in the market. The S&P has met its measured move at that 55.35 level we talked about, and what I'm not seeing is the kind of bearish parallelogram that we have seen all the way down, which is just a bearish consolidation, but perhaps something like an inverse head and shoulders base, a small one, perhaps, or in some cases some rectangles, but we are definitely seeing a change in character, at least in the price action. So let's look at the NASDAQ 100. Notice a bunch of these upward sloping parallelograms or bear flags. They're bearish consolidation continuation patterns. Over here, we're getting something more like a rectangle. Now, this could still be taken as a bearish consolidation, but it is the least bearish of the bearish consolidations. It could also be taken as something like a W bottom. So we had kind of a successful test of the week's lows right over here on Thursday. The Dow met its measured move at 40,875, and you can see again something that may be like an inverse head and shoulders. What we're not seeing is that parallelogram kind of bear flag that we've seen, throughout this decline in most of the averages and a lot of stocks. As far as volatility, we are seeing relative weakness, a relative weakness trend in VVIX, the volatility of VIX. And what I've done is invert the S&P 500's price action for context so it's easier to see, and this is VVIX in blue. This is confirmation acting how it should act on a market sell-off. This is major relative weakness in VVIX. VVIX's relative weakness trends let's not say relative weakness trends, let's say relative performance trends, whether positive or negative, tend to lead VIXs. So we can see the same thing in VIX now, some relative weakness in VIX. It's not acting the way it should be when the market is down. VVIX leads VIX, and VIX relative performance trends tend to lead pivots in the market. So this also is suggesting, at least at minimum, that the hedgers that bought puts to hedge downside risk are monetizing those puts at the very minimum. They are less afraid. We're seeing evidence of some buyers dipping their toes in the water. If we look at volatility's term structure, it went into backwardation or extreme fear. These white bars painted on the S&P are extreme fear. They tend to be contrarian signals. So we get extreme fear, backwardation, and volatility, and then it's kind of like a market low is nearby and we get a bounce. Here's another one, another, and this. Unless you're in an all-out crash like the 2020 COVID crash, and volatility will stay in backwardation the whole time. More often than not, what this tells us is that we've reached an extreme in sentiment, and it's a contrarian signal. As of last weekend's video, we weren't getting anything that was jumping off the charts, like the 3C charts, that were suggesting a high probability reversal. We came into this week looking for evidence that selling was starting to dry up, particularly from CTA's commodity trade advisors, which are trend traders, and other systematic traders. We were looking for signs that their deleveraging was starting to run its course. I've seen signs of that in 3C, and I'll show you. And Goldman Sachs, who also tracks this and models this, has seen signs of CTAs being done deleveraging their long exposure, and now they're modestly short about 30 billion of U.S. equities, with the model predicting just 2.6 billion more for sale in a flat tape over the next week. So it's very modest. As far as the 3C charts kind of depicting the same, I'm not going to go into like all the evidence because that's for my subscribers, but to give you kind of like a feel. Here is SPXU, which is a 3x short S&P 500 ETF. You buy it, you have short exposure, so it going up means the market going down. I actually went with this on some ABI signals. I wish I had gone with the NASDAQ short, but there was such incredible accumulation in here right as we were getting the ABI signals in this area. You can see what we're seeing over here is some pretty heavy profit taking. I ended up closing out a few runners that I had like 1 minute before Friday's close. The reason for that was my trend channel. This is actually the post on Friday of me closing out that trade because of the trend channel. So it has held this entire downtrend. It had a stop just shy of 56.23. We closed above that. It's always on a closing basis for this kind of a swing trade. It's objective evidence. So for me, it was like no question, just take the profits and run with those. Made almost 3 times what the S&P fell, I think around 28% in that ETF. But the point is that we're seeing broader profit taking over here in the same SPXU. On a trend basis, you can see as megacap earnings came in towards the end of January, 3C just started to deteriorate a lot, negatively diverge, leading into this decline. Right now over here, if we look kind of a little bit closer, we do have a positive divergence. 3C is not making a lower low over here. This is not screaming and jumping off the chart and saying, oh yeah, everybody's jumping in long. It's not saying that. It's saying that the selling pressure that we saw in here has lightened up significantly towards the end of this week as kind of we expected. For the kind of signal that we're looking for to jump in on the long side with both feet, we're looking at the shorter term charts. Are we seeing money coming in really heavy right now? And when we look at those time frames, what we see is 3C leading price down, right? And then as we come into this week, it's getting a little bit better. The selling pressure is abating a little. A lot of that is the mechanical selling from CTAs. And I talk about CTAs and people get confused. They are systematic trend followers. They do not make decisions based on discretion. Like, well, we think the market might do this. We think earnings were pretty good. It's just, no, a price level was hit. They sell. Price level was triggered. They buy. That's it. But they all have similar models, so they move in this massive herd. It's like a stampede. When they are selling, it's like it doesn't matter who's buying. They cannot overwhelm that selling pressure. So when they are done selling, and that's what we've been looking for, you can start to see the buyers get control of the market. So on the shorter term time frames, as we're coming in to this test of the lows this week, we see some improvement in 3C. So what this is telling me is that we're seeing buyers dip their toes in the water. They're not really convicted. They're not really convinced and feeling great about the market, but they're dipping their toes in the water the same way that the shorts in the leveraged ETFs, kind of the fast money, are taking profits. Small caps will often lead price pivots or changes in direction, in large part due to their sensitivity to like shorts or short covering. So hedge funds have been shorting a lot, and small caps really track the most closely with my most shorted index. So let's take a look at IWM's 3C chart. And what we see over here is a similar theme of 3C either leading lower or confirming into this week. And then we're seeing some improvement over here. We're seeing some buyers dip their toes into the water. But I think maybe more importantly is we're starting to see some of the mega caps come around. Let's face it, 7 stocks are pretty much the market. So the market's not going anywhere without those mega caps on board. I use MGK a lot, just to keep things consistent, the Mega Cap Growth Index. Notice the price trend decline. We have these upward sloping parallelograms, bear flags, and really they don't even get to form before we see more selling. So it's been pretty vicious selling. This is kind of like a hallmark of CTAs, but we get into this week and look, we have this tested low, right? It could be a small W bottom, could be a rectangle too. We don't want to get like too ahead of ourselves, but this is more constructive price action than what we've seen this entire decline. And on MGK's 3C chart, a lot of the same kind of similar action that we're seeing elsewhere, with 3C confirming to the downside into this week right over here. We start on the 10th. And then we're seeing some more positive action in 3C as we see price test Tuesday's low on, I think this was Thursday. So Tuesday's low over here, tested on Thursday, successful test, not a lower low. We don't have that kind of bear flag feel, and we have more constructive signals in 3C. Are they jumping off the chart and saying, yes, buy, pound the table and buy? No, not yet. But I find it's helpful to look at the market in terms of rate of change. So just like turning a big truck, you don't go from heading straight to a 90-degree left turn. There's an arc in there. There's a rate of change. There's a change in character in the market. It almost always will give you these hints if you look at them. So like the change in character in price action, the change in character in 3C. For a lot of people that can't follow the market closely, it looks simply like the market went from an all-time high, like we saw in February, to down 10% in, just like a day. It just changed. That's not what happened. If you watch my videos, we had several weeks of warning in these changes of character. And here is the most important sector, the most heavily weighted sector in the market, technology, right? On a weekly chart, 3-4 weeks of decline. It's been nasty. It's been ugly. What is this? A bullish hammer, as in hammering out a bottom. This is the most constructive price action that we've seen during this entire 4-week sell-off. Guess who else put in a bullish hammer? MGK. So this week has been a slow build of objective evidence. I have my opinions, but I'll tell you, hey, this is my opinion. I can't back it up with objective evidence. I can't present you a chart and say, assess this and see what you think. But this week we have seen this slow trend of objective evidence building up probabilities toward a trend change, because even if the market has more downside to go, the market has oversold rallies. It has short covering rallies. Like I said in the beginning, the market trends, but it does not move in a straight line. There's not enough objective evidence for me to feel great about jumping in on the long side in any kind of size, but there was enough objective evidence for me to close out the runners that I had left on short exposure to the market. Why do I need more objective evidence? Because I don't know if the market is going to put in a strong oversold rally or it's just going to put in a bigger kind of bearish consolidation. I don't really want to be long a bearish consolidation, although the market will go up modestly during that. I want to be long something like a nice swing trade that's going to see a nice oversold kind of short covering rally that really gains, a good 5-6% at the index level. We may get additional evidence. It seems like we're moving in that direction if you look at the rate of change. And that may happen within hours of the open on Monday or even on Sunday night when futures open. I need a little bit more evidence that buyers have more conviction, that they are stepping in with more conviction. What I lean toward, my gut feeling, again, because I don't have objective evidence yet, my gut feeling is this broadening formation, which is a sign of chaos. Higher highs, lower lows, we just made a big lower low. My gut feeling is that we get an oversold rally heading toward a new higher high and maybe stalling out around 6,000. Would I be long that trade? Heck yeah. But even though these are rare patterns, these broadening formations, you don't see them that often. And because they're kind of rare, I don't have as much experience saying, yes, they're very reliable with measured moves. But the measured move for this would be around 5,300. Okay, so down here at 5,300, if I can get a rally up here and ride that rally and then get short at 6,000 down to 5,300, I am happy. Either way, however this goes, this is not a constructive price pattern whatsoever. It represents chaos. It represents a lack of leadership. It represents a market that is reacting to rumors, that's reacting to news that lacks intelligent sponsorship. Markets hate uncertainty. This is the literal depiction in terms of like mass psychology, how price represents mass psychology of chaos and uncertainty. To brighten things up a little bit, we're not just short stuff. So our gold long added another 2.5% this week to a new record high. Our copper long 3.3% this week, doing great, looking great. There's a lot of things to be long. I like being long and short the market, just depending on where it's going. I just want to be on the right side of the market. So I left a lot here for you to chew on. What do you think? If you like the video, help me out with the algo, give it a thumbs up. I'd appreciate it. If you haven't already, take a second to subscribe to my videos. I get on here when things are happening. I'll get on here every weekend, to let you know, because I really do feel like my mission is to help the little guy. The market is rigged against us. So anything I can do, but I also have to make a living. The more views I get, the more videos I'm going to do. But when I come on here, I usually have something important to say, something pivotal at a pivotal point in the market. So don't forget to subscribe and also hit those notifications so you get a notification when my latest video is out, because you know how fast the market has been moving lately. If you are ready to receive this kind of information on a daily basis in real time, come and subscribe at Wolf on Wall Street Trade. The link will be in the video description. If you do it now, before we move to our new website, technicaltake.net, you will be grandfathered in at 2008 prices. Everybody, thank you so much for listening and have a fantastic weekend.